Warning: Google just reported Q4 earnings, and 95% of investors are reacting the exact wrong way. They're focused on the headlines. The real story is buried underneath, and it changes how Google should be valued going forward. If you're holding Alphabet stock and you don't understand what Google is turning into right now, you're not investing, you're guessing. Let me show you what most people missed. Let's start with what everyone saw. February 4th, 2025. Google reported Q4 revenue of $96.47 billion, up 12% year over year. Not bad, right? Net income hit $26.54 billion, with earnings per share of 2.15, slightly beating analyst expectations. The market's initial reaction: Google shares dropped nearly 7% in after-hours trading. Wait, what? The company beats on earnings and the stock tanks? That's your first warning sign. Here's what happened. Wall Street expected $96.56 billion in revenue. Google came in at $96.47 billion, a miss of less than 0.1%. But that's not what spooked investors. The real shock came from the cloud business. Google Cloud generated $11.96 billion versus the expected $12.19 billion. And then Google dropped the bomb. They're planning to invest $75 billion in capital expenditures for 2025, massively above Wall Street's expectations. Now, most people see that CapEx number and think wasteful spending, but that's exactly backward. This is where you need to pay attention because Google just told you their entire strategy, and whether you make or lose money on this stock depends on whether you understand what they're really doing. Here's the game that's being played right now. Every major tech company, Google, Microsoft, Meta, Amazon, is in an all-out war to build AI infrastructure. And whoever builds it first and builds it best wins the next decade of technology. Think about it like this. In the gold rush, the people who made real money weren't the gold miners. They were the people selling picks and shovels. But in the AI race, Google isn't just selling the shovels. They're trying to own the entire supply chain from the mine to the market. Google Cloud revenue increased 30% to $12 billion, driven by Google Cloud Platform growth across core products, AI infrastructure, and generative AI solutions. That 30% growth is massive. But here's what's even more important. The quality of that revenue is changing. Google isn't just renting compute anymore. They're building custom silicon with their TPUs, tensor processing units designed specifically for AI training and inference. While competitors like Microsoft and Meta are writing massive checks to NVIDIA for GPUs, Google controls their own chip destiny. Why does this matter? Because in 5 years, the companies that own their AI infrastructure will print money. The companies that rent it will struggle with margin compression. Google is betting $75 billion that they'll be in the first category. But here's where it gets complicated. Google has a golden goose problem. Google Services revenue, which includes search and YouTube ads, grew 10% to $84.1 billion. That's still the core money printer. But now Google faces something they've never faced before, a genuine threat to search dominance. Not from Bing, not from DuckDuckGo, from themselves. Generative AI like Gemini could fundamentally change how people find information. Instead of clicking through 10 blue links, you get one AI-generated answer. Sounds great for users, right? Catastrophic for Google's ad model. Every time Gemini gives you a direct answer, that's one less click, one less ad impression, one less opportunity to monetize. Google built a $200+ billion advertising empire on people clicking links. What happens when AI eliminates the need to click? This is the tightrope. Google needs to push AI innovation to stay ahead of OpenAI, Microsoft, and others. But every step forward in AI potentially cannibalizes billions in search revenue. And here's the kicker. They don't get to choose. If Google doesn't cannibalize themselves, someone else will do it for them. As if the AI transition wasn't enough, Google is fighting a multi-front legal war, and they're losing. In April 2025, a judge found Google liable for unlawfully monopolizing publisher ad server and ad exchange markets, stating the company had substantially harmed publishers and consumers. That's the second major antitrust loss. In September 2025, U.S. District Judge Amit Mehta finalized remedies in Google's search antitrust case. While Google avoided the nuclear option of being forced to sell Chrome, the court banned exclusive contracts that made Google the default search engine and required the company to share some search data with competitors. Let's put this in perspective. Google pays $18 to $20 billion a year to Apple just to be the default search engine in Safari. That deal is now effectively dead. No more paying for default placement, no more locking out competition. For years, Google's moat wasn't just about having the best search engine. It was about being the only option people saw. Open your phone, Google. Open Safari, Google. New Android device, Google everywhere. That fortress just got breached. And while Google will argue they win on merit, the truth is defaults matter a lot. Studies show most people never change default settings. Google knew this. That's why they paid billions for those defaults. Okay, enough doom and gloom. Let's talk about why Google could still be one of the best investments of the next decade. First, the numbers are still absurd. Alphabet's 2024 revenue reached $350 billion, up 14% year over year. The company generates obscene amounts of cash. Nearly $70 billion returned to shareholders in 2024 through buybacks and dividends. Second, while everyone panics about search disruption, YouTube is quietly becoming a monster. AI-powered recommendation engines are making the platform stickier. Users watch longer. Advertisers pay more. The AI feedback loop, content recommendations, ad optimization, creator tools is printing money in real time. Third, the cloud business is hitting an inflection point. The number of first-time cloud commitments more than doubled in 2024 compared to 2023. Google closed multiple deals over $1 billion. This isn't hype. This is enterprise adoption at scale. Fourth, and this is crucial, Google has $110 billion in cash and minimal debt. They can outspend nearly anyone on AI development. The $75 billion capex isn't reckless, it's strategic aggression. When you control the silicon TPUs, the models, Gemini, the infrastructure, Google Cloud, and the distribution, Android, Chrome, YouTube, you're not just playing in the AI game. You're building an ecosystem that's incredibly hard to disrupt. But here's the reality check. All those advantages mean nothing if Google can't execute. And right now, there are massive execution risks. Google stock gained 27% in 2024, which sounds great until you realize the company is at a crossroads. They're caught between protecting their cash cow and racing toward an uncertain AI future. Google's AI products are confusing. Is it Bard? Is it Gemini? What's the difference between Gemini and Gemini Advanced? The messaging is muddled. Meanwhile, ChatGPT has become a verb. People say ChatGPT this the way they used to say Google this. Brand confusion is a warning sign. It suggests internal politics and competing priorities. Product teams fighting for resources. Executives protecting their turf. Innovation slowed by committee thinking. Big companies move slow. In AI, speed is everything. OpenAI launched ChatGPT Web Search in October 2024, positioning itself as a direct Google competitor. Google's response? Incremental improvements, not the revolutionary leap you'd expect from a company betting $75 billion on AI. There's also the China problem nobody talks about. Google doesn't operate in China. Meanwhile, Chinese AI companies are moving at breathtaking speed with models that rival Western competitors at a fraction of the cost. If AI becomes commoditized, Google's infrastructure advantage shrinks. So what do you actually do if you own Google stock right now? First, understand this isn't a momentum play anymore. The easy money has been made. After the Q4 earnings report, Google dropped 6.94% in a single day. That volatility isn't going away. Second, your thesis has to be long-term. If you're holding Google, you're betting on two things. One, that Google successfully transitions from a search advertising company to an AI infrastructure company. 2, that they do it without destroying their core business in the process. That's not impossible, but it's not guaranteed either. Third, position size matters. This isn't a stock you want to overweight right now. The risks are real. The antitrust penalties could get worse. The AI transition could stumble. The cloud business could miss numbers again. But here's what you can't ignore. Google is still one of the most profitable companies on earth. They're generating cash at a rate most companies can't even imagine. They have the resources to win. The question is whether they have the speed and culture to execute. Here's my take, and this is where I'm putting my own money. Google is a hold with selective accumulation on weakness. I'm not backing up the truck at current prices, but if we see another panic sell-off, I'm buying. Because at a certain valuation, the cash generation and buybacks become too compelling to ignore. The bull case is that Google executes the AI transition, monetizes Gemini across their ecosystem, maintains cloud momentum, and continues dominating digital advertising even as the landscape shifts. If that happens, this stock could easily be worth $250, $300 in 3 years. The bear case is they fumble the AI rollout, antitrust penalties worsen, cloud growth stalls, and someone else, OpenAI, Microsoft, maybe even a Chinese competitor, eats their lunch. If that happens, you could see the stock trade flat or down for years. Right now, I give it 60-40 odds in favor of the bulls, but those odds could shift quickly based on execution. That's why this is a watch closely position, not a set and forget. So here's what I want to know. Are you holding Google stock? Are you buying this dip? Are you staying away entirely? Drop a comment below and tell me your thesis. I read every single one, and I want to hear your take. And here's the thing, Google isn't the only mega cap tech stock facing this exact dilemma. Amazon, Microsoft, Meta, they're all navigating the same AI transition, the same regulatory pressure, the same execution risk. If you like this video, watch the one popping on your screen now. Because in markets like these, information isn't just power, it's profit. And I'll see you in the next one.